Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, January 31st, 2019. In this video, I want to take a look solely at the long-term outlook, the bigger picture of the stock market. In recent weeks, I put a lot of focus into the 60-minute charts, the daily time frames, trying to gauge where we're going, and I don't want to lose sight. I think it's imperative, critical to an investor, even a swing trader, to not lose sight of the longer term charts, the technical outlook, and the longer term time frames, even if that's not where you're honing in on your entries and exits. In other words, I don't use a weekly chart to enter a swing trade expected to last a few weeks. I will help maybe use a weekly chart to formulate, hey, is a stock running into support or resistance? Does it look like it's in a bearish or bullish trend? And then I'll zoom down to the daily charts, 60-minute charts, sometimes even the 15-minute charts, and hone in on the proper entry point, maybe a breakout above a trend line or a resistance level or a chart pattern. Now, so what we're going to do, I'll keep this video limited to, we're only going to cover QQQ and SPY, the two large cap ETFs that I track the most, and then a handful, maybe 10, no more than a dozen of the top largest components of QQQ and SPY. And I want to do that because, of course, they have the highest weighting in both of the indexes. And those are, some of the, market leading companies. So that if we can if all those charts are in alignment telling the same story, I think it helps to make the case. So in other words, I don't want to, I could sit here and cherry pick, just say QQQ, not show you any other charts, and draw trend lines like I want and try to make my case. I try very hard when doing technical analysis, charting, to make all cases. And if I can sit here and draw some valid trend lines that maybe refute what I'm seeing, then I will point those out. And I have mentioned that before, like this one I just threw up. There's a possible trend line. It's not super well defined. You can drag it out here and say, okay, well, maybe here's a trend line that QQQ caught support on. So I look at things like that, and it's in trading. Trading can be tough enough. So, it's not about manipulating the charts to see what you want to see to support your case. That's confirmation bias. I like to look at a chart or a trade and pick it apart and say, okay, what can I put up here? If I'm bullish on this stock right now, for example, I'm bullish on the stock, uh, what bearish case can I make? Let me try to make a bearish case on it. Let me throw up some trend lines, some other technicals, and see if I can make a bearish case. And if I can make a pretty decent bearish case, in addition to the bullish case I'm making, that one maybe stand aside. So, in other words, the charts should be clearly bullish or bearish, and again, it's how you look at them and how you perceive them. Again, confirmation bias, I've always said, is probably the single most hindrance to any investor or trader. Nobody's immune to it. I'm not immune to it, but I try to be very cognizant of it. And if you're not familiar with what that is, quick Google search will give you the answer. Okay, and before we get into the charts, I just want to talk real quickly on fundamentals. For those of you not familiar, there's really two disciplines in methodology, I should say, in trading and investing, and that is using fundamental analysis or technical analysis. Technical analysis is the bulk of what I do on these videos. It's charting, using charts, looking at price, volume, trend lines, indicators, all kinds of good stuff. Whereas fundamental analysis is, kicking the tires of a company. Warren Buffett, he's a famous fundamentalist, uses fundamental analysis in his security selection. And that is digging into the balance sheet, getting to looking at the earnings of a company, their prospects, and all that kind of good stuff. Whereas again, technical analysis is trying to determine where a stock is likely headed based on what the charts are telling you. Now, I think they both certainly have their value. I mean, obviously Warren Buffett's track record proves that. He may incorporate some technical analysis into his trading, but he's largely a fundamental investor. So, but it is only good fundamental analysis for longer term predictions of where a stock or the market is going. There's not a day trader in the world, I give you my word on this, not a day trader out there that uses fundamental analysis and deciding what to buy and sell and close it out at the end of the day. Swing traders, for the most part, only use technical analysis as well. I will marry them both. And of course, on the right side of the chart, I do just personally myself with my IRAs, long-term money. And then some of the trade ideas that we have on the site, like the gold trade we closed out yesterday, that was a long-term trade, a trend trade. I will use fundamental analysis. I will most certainly factor it into my security selection, again, for the longer term trades that are expected to last 6 months or more. Those, I think the best trades out there are when the fundamentals and the technicals align. So enough on that, but I want to talk a little bit about fundamentals. If you recall, when the market topped last fall, it was clearly, to me, very clearly forecasted in the charts, and I was pretty emphatic we were going to have that drop. And when it happened, in a lot of the videos, not all of them, but a lot of the videos, I talked about what would happen, what was going to happen going forward. I said, number one, we're going to go down beyond where most people thought we would drop. And then I said, as it happened, you'd see a couple things. You would see number one, you'd see the Fed move from a hawkish stance to a dovish stance. You would see them cow down on their dot plot trajectory. That's the expected forecast of rates hikes. I think they were looking at 3 in 2019, if I'm not mistaken, which is now 0. So that clearly happened. And the other thing I said is, we started to go down, you would see economic expectations and forecasts revised downwards, which we clearly did. All throughout here, the trend was the majority of economic forecasts were revised downward. However, as we started to get overdone, at this point here, I started to say, as we were melting down towards the end, okay, now the risk reward isn't very attractive on the short side. It's quickly moving over to the long side. I was looking for a rally in December, late December rally into January. We got that. And at that point, I said one of the things that would happen, I said at this point here, I said this is overdone. The market has now, the pendulum has swung too far. The economy is actually not at all in bad shape. And this was an overreaction in the market, and therefore you'd get a sharp snapback rally once everybody realized, hey, the economy's not falling off a cliff. That's all I'm hearing now. But again, that's old news. I'm trying to get in front of this. Here is where we finally saw that. We've seen the Fed start to reverse on their stance. Yesterday was, to me, just more of a crescendo. It was, the Fed has been backing off for a while, and just because they didn't hike yesterday, we saw markets move up pretty nicely, and it's crazy. I read the headlines, like Barron's, Wall Street Journal, all these, and the headlines across the board, at least from the Journal, this morning looking at it. Stock market rallies on the Fed holds. They attributed the rally to the fact the Fed did not raise rates. That is ridiculous. I mentioned before the FOMC announcement yesterday, I checked the Fed Fund futures. You can do a Google search, CME, Fed Watch tool, I think it's called, and they'll show you the probability of a rate hike. And the probability is simply based on the, how traders, smart money institutions are trading Fed Funds futures. And they had, which I rarely see, they had a 0% chance of a rate hike, not a 0.01. There's usually a small percentage in there for a surprise. If you're statistics, if you're science-oriented mind or statistics, there's very, very few things are 100% as far as probabilities go. But they had that in there. So what I'm trying to say is, the market rallied on news. That was not the reason they rallied. There was a 0 chance of the Fed raising rates yesterday. 0. And that was priced in. Everybody knew it. Again, maybe they like what the Fed said. It just confirmed the fact that they've now backed off their previously, more hawkish stance. So where we're at, where I'm going with this, a lot of talk on the fundamentals, is that everything that I've been hearing now in the last, especially more so, again, it's reached that fever pitch in the last week or so. That's priced in. That is, to me, priced in almost, if not fully, on this 16 or so % move on QQQ off the bottom, whatever it is there. I'm trying to measure. So now where do we go from here? Well, I'm going to show you the technicals. This video from here on forward will be about the technicals. I feel very strong on where these charts are. As far as the fundamentals go, So I think what will happen is, okay, so the Fed is now back to, an accommodative policy. They're not cutting, but they're not going to raise rates. They're tapering off the balance sheet a little less than people thought they might. Got it. But the focus, I believe, will now turn back to the fact that the economy has turned down. Just about all economic indicators I follow have been rolling over. Housing, everything else you see down the road, they've all started to turn down, and it appears that we are still, we have been for a while in late stage economic expansion. We're probably in the early stages of a contraction. And so where I'm going with this is, I believe going forward now, we're talking next month, 2 months out from now, not starting from here, you'll start to see the headlines change and talk about the slowing economy. And therefore, we're going through earnings seasons right now. I'm very aware that a lot of companies that have missed are still rallying. I get it. I get that. But we're looking at numbers, that go back as long as 4 months. When a company reports quarterly earnings, that's for the last 3-month period, but they wait about a month after the quarter's closed, up to a month. So it's dated information, really. And again, so the market will start to turn its focus back to what's going to happen next quarter and the quarter after that. All right, so enough of that. Again, I think the fundamentals are important. Now let's dive into the charts, and I'll show you what I believe to be a pretty consistent theme here. And we're only going to look at weekly charts. Let me put this line down here. And I'll toggle between, if you'll notice up here it says weekly, you might see me click over to what it says 6-day period. That's just a limitation of this charting platform, TC2000. I like it for using the videos. I use about a half dozen different charting platforms. This is only one of them. But they have a limitation on a weekly chart. I can only go back 10 years, so it cuts off the 2009 lows, which happened in March of 09. So if I change my candles from a weekly, which are five trading days, to a 6-day period candle, that's a week and a day. It gives me that. I just wanted to mention that. So because I want to show you these bull market uptrend lines. So here's a common theme. We have a lot of primary bull market uptrend lines off the 2009 lows have now been broken. Not only were they broken, those were pretty powerful sell signals in themselves, but we've now come in and we're back testing those levels. And again, it's a pretty consistent theme. So I'll go through these charts pretty quickly here. We have the key 200-day moving average, which on a weekly chart is a 40 period. Here, I'll go back to a 40, a weekly. So you can see, as I've talked about, so here you have the 200-day or 40-week moving average coming in right at a perfect back test. Now here's the thing about back testing, guys, and this is why I mentioned to members of the site yesterday, I've been scaling out. I've mentioned this all along on these videos. Back somewhere in the mid 2018, I said, look, I'm out. I've moved my entire all the 401k money, that things that you can't actively trade in, 403b plans, money purchase plans, where you have the mutual fund options, and you have just basically large cap, small cap, mid cap, international, bonds, and money market. Those are your options in most 401ks. So that money I moved into cash here, and I mentioned scaling in long as we came into the December lows, scaling in. And then I mentioned recently scaling out in the last few weeks, and most of that scaling out was in sideways market here. As of yesterday, that's it. I had 20% going into about 20% equity exposure roughly yesterday and before the close, and I transferred a big chunk of that, almost all of it for all intents and purposes, a little bit left, but it's mostly in money market and cash. Why? Again, I'm going over this video because this still appears to me to be a bear market rally. Why? Because we had primary bull market uptrend lines broken on not just one stock or one index, but a lot of them. Long-term trend indicators that flip to sell signals and bearish. Again, that was another video I did recently. I'm not going to go off topic on this one. We'll just keep it to these weekly charts. And the thing about back testing and trying to time it, and that's why I use scaling in and scaling out in those type of accounts that you can't actively manage. Completely different from a swing trading account, an active trading account. But here's the thing about back testing. We back tested here, and we back tested here, and we're back testing again, and we can continue to back test. There are no guarantees that we fail after the back test. But again, what will happen at some point, I believe, is bear markets, even bull markets, most trends don't like to let a lot of people in. If you don't know what I'm talking about, think back to December 26, that candle right there. This is typical nature, especially in a volatile market and strong trends like this. They don't let the shorts out. And first of all, they don't like to let the shorts in or the longs out. See, so longs here, they're just dip buyers were doing their thing, buying dips, market's going to go up forever. And then boom, that caught them off guard. And so they figured, okay, that one was a little rough. We'll keep buying the dip. Boom. And so what it did, this very impulsive price action, what that does, it traps longs in. At this point, they didn't sell and they're saying, oh gosh, I want to get out. And you probably, if you're listening to my voice now, I know there were some of you that were of this mindset. Oh gosh, this is getting pretty ugly. I need to get out. I'm just going to wait to get back to where I was or close to it. It doesn't give you that opportunity. That's what a correction, that's what a bear market does. Just like here, for those that were short and in my opinion, getting greedy down to the lows. If you were short on the 24th, and if you tried to short this rally, you got smoked. It went up. We went up so fast, so quickly, and there were very few ops to buy back in. We had one little pullback here. But maybe some shorts did cover there, but again, a lot of shorts got trapped in here, and more importantly, I think a lot of longs got left out. And now they're buying. They think, okay, now it's safe to get back in the water. This is when I thought it was safe to get back in the water. Even on this pullback I mentioned when we did that, I thought that would just be a pullback. We'd continue higher. But at this point, I think this is where a lot of the retail money is buying right now. That's my guess on where we're at in the market. Again, we have some pretty significant levels right now. Here's a 200-day. It looks like we're now, market just opened. Looks like we came up and kissed the 200 in that trend line today. So there it is. In fact, I may have to go stop the video and put on some shorts right now. Okay, sorry about that. I had to pause the video. I have a couple, self-directed IRAs. Those you can short via inverse ETFs or options if that's your thing. So I just wanted to add some on. Again, I mentioned this as being very significant resistance. I hate to get off topic, but that's that downtrend line on QQQ on the daily. Told you I wouldn't focus on the daily charts, but I wanted to use that example. But there it is. Boom. 200-day EMA, downtrend line hit. Doesn't mean we can't pop and go through it. In fact, they might want to run it intraday, but look for a solid daily close above, and got to give that to the bulls. But we also remember, we had a solid daily close above it back here, above the intersecting 50 and 200, and you see what happened the next day. So, all right, back to the charts, and we'll wrap this up. All right, so here's QQQ. You can see primary uptrend line off the 2009 lows, broken and back tested. We have several reactions to help validate this trend line. Back on the 09 lows, that's where it started, and a lot of reactions. You can see we hugged it there for several weeks, and we broke it. We didn't just limp through. There was a big red impulsive candles. Now we're back testing, and we're back testing for the first time. I showed you we're close to that 40-week moving average, but we weren't there. That's the same as the 200-day I just showed you. So this is the first test right now of the 200-day moving average and 40-week moving average. All right, SPY. SPY, I can draw several trend lines. You can see them here. But the one that I'm focused on right here, we have these two here coming off. Let's focus on these two right here off the 2009 lows. You can see the yellow trend line comes in, captures that reaction low from 2016, captures all of these recent candles right here. So when we started to come down, we broke what I believe to be a very significant trend line right here off the 2016 lows. Let me color that up for you. I got too many lines going right here. All right, so this one was very important. That was well defined both in SPY, and a lot of individual stocks had that one. Again, nope, I hit the wrong one there. Oh, you can see it. There's also one right off the 2015 lows. That's why I had so many trend lines. So we've had trend line after trend line get taken out, and including the primary bull market uptrend line. We're a little bit below that on SPY right now. But now let's go through the top holdings within the S&P 500. Okay, so we're going to go through the top holdings of this SPY. That'll give us a little more diversity. Most of these are the top holdings in QQQ as well, so keep that in mind. And in QQQ, they have even a higher weighting, the top components do, than in SPY. So here's Microsoft. On Microsoft, I don't have a trend line off the 2009 lows. Microsoft seems to be in its own little world of it's in a secular bull market. But that's punctuated with these, all different periods. This, for example, was a sideways trading range, multi-year. You went absolutely nowhere in Microsoft for what, 3 years at least, and then you had a nice trend. So Microsoft, like a lot of these companies, they trade well to the technicals. If you can identify these trends, there's a very clear, well-defined uptrend line with a lot of tags. Rising channel, we had a divergent high there. We had a correction. We had another divergent high and another correction. They were both about 21% corrections. Call them bear markets if you want, but really they're just that's semantics. They're just corrections within an ongoing bull. So here we started trending up, had another divergent high, 15% correction. Now this, I mean, come on, trend lines don't get much better defined than that. Very well defined, and again, that's the one I was talking about off the 2016 lows in a lot of stocks. And like everything else, it ended with a divergent high. That was your heads up that, that this trend line was most likely going to break down sooner or later. We didn't have divergences up until that point. So that's TA 101. When you start to identify a trend, the trend line is supports. You buy pullbacks to support. That's what you do until you start to see the divergence, because that indicates an impending trend change is likely. So at that point, you position for a break of the support, which is what we did back, last fall on the markets and a lot of stocks. And with Microsoft, you can see we broke down, back tested, and moved down. And what we did is we hit the first support level. Now, the correction could be over. I haven't measured it out here. It's probably in line with these, but I can say this. Number one, this was a much larger trend line, very steep. It was a longer uptrend. I expect more downside. And again, the fact that the broad market and so many other stocks have broken their bull market uptrend lines, I am of the mindset that these recent drops are not just corrections in an ongoing bull market as these other ones were, and those were great buying ops, but more likely the beginning of a much longer bear market. So if I'm, as of now, that's how I'm treating this. I won't be married to that bias. There's still work to be done on a lot of these stocks. I'm going to give you both sides. As I said, Microsoft, the trend indicator is bullish. I use that 9 EMA. If I don't mention on a lot of the stocks that we're about to go through, just look at that. You look at the zero line, the dotted line there, and when that white line, the last of the two to cross, is above, the trend is bullish. And so with a very small exception there, and there was actually, would have got you out, there was a bear market or a 21% drop. This has told you the primary trend on this chart, this weekly chart, has been bullish and is bullish. And the only time it would have kept you out of Microsoft or short was back here and here, and you would have done well. So I'm watching that. Right now, that is bullish. So again, this isn't an all-in type of short situation yet. I can't say definitively whether this recent drop that we had last quarter was not just another, one of these run-of-the-mill corrections in the greatest bull market in history to come. But so far, it appears that it probably was the first thrust down with more downside to come. And then when we start to see a lot of these longer term trend indicators on some of these key stocks roll over, those that haven't already, I should say, that's when we'll know we're in a bear market. Amazon's already rolled, crossed down below. The last time that trend indicator was down there, you can see was right here. Said sell signal, and I could measure it out, but I can tell you that's a double-digit drop, and if nothing else, it was a sideways to down market, so you would have been well to just step aside Amazon. And the only other time, again, we're looking at a decade of chart history here. The only other time was right here, and that told you be out of the stock. All along since then, it has said you want to be long Amazon, the primary trend. Again, I'm talking long-term trend stuff. The long-term trend is bullish until now. So I play the odds, I play the charts. I don't react to what, sentiment is in the market or, some a recent rally or anything like that. This is long-term stuff. Again, this is what has prompted me as of yesterday to now go to nearly a 100%. Well, yeah, I'd say it's about, I don't know, 70, 80% cash and the rest treasuries in long-term funds, and then swing trading accounts. I'm still short for now. All right. With the exceptions, I balance. I have a lot of different investments. Some are long, some are commodities, things like that, and they have no correlation to the broad market. But there's another check mark, and so I talked about the trend indicator there. What I didn't show you up here, and you can see clearly a very, very well-defined trend line goes back all the way to again to early 2015. A lot of reactions along that trend line. These other corrections, if you will, and they were defined by these minor trend lines. There's a bearish rising wedge. They were corrections that just took us back to the primary uptrend line. So those were good buying ops. You can see another correction, 14% drop off that divergent high. That's marking the divergences, by the way, these correction numbers. And then here we had a nice clean bearish rising wedge. It was identified in advance. So it was the breakdown. And so were the targets for Amazon, which were hit on my downside targets on that. But this time around, what was different is it took us down below the primary trend line off the early 2015 lows. And just like the stock market and so many other things, we're back testing that trend line from below. It doesn't get any better than that from, when you're using technical analysis for an objective short entry. However, like I said, these are weekly charts, so the timing, you're going to have to give it room. If you're running, let's say a short on Amazon, they're coming up to report tonight, so don't do anything in front of earnings, but if, for example, if you want to swing the next leg down, you're going to have to give it room. The market is volatile. These stocks are volatile. You can run a 3% stop. You're going to get stopped out on the day-to-day noise on these. But if you're taking the bigger picture, if you were, and I had a lot of inquiries on the site, people that owned Amazon forever, and they, Randy, what I do? Would I hold? What I do when it was going down? I showed you where my targets were. Here it is. Again, these targets were put out here in anticipation of this wedge breaking down before it even broke down. This is where I said Amazon would go, and you can see how accurate that was. Hit that final target. So when we got down here, my point is, look, here's the downside, what I see likely downside, and there were no guarantees. I don't want to sit here and tell you that I can say bet the farm on it, but that's where to me, the case was very strong for reversal in Amazon. Bullish divergences, just like we had the negative divergences at the highs, hit that target, slight momentum fueled overshoot. You can see big doji, right? The doji was exactly on my final target. So now, where am I going with that? That's technical analysis. It told me that we were going to go from here to here. And technical analysis has said we go from here to here. And now we can see we've hit this downtrend line. You have some price resistance. If we happen to pop that downtrend line, and remember they do report tonight, I believe it is, then there's resistance right there. But again, bigger picture says, okay, we broke a primary trend line. We're back testing. That's an opportunity. If you got caught in here and you swore that you wouldn't do it again, you wanted out, this is an opportunity to either get out, or I'll say this, maybe I'm wrong, and sometimes you do back tests and the trend lines get recovered. I'm going to say that right now. So here's an option for you. If you rode this whole thing out and swore to yourself you wouldn't let this happen again, and you were afraid that this was going to happen on Amazon, just set a stop. At this point, set a stop below the recent lows and let it ride. Maybe I'm wrong and Amazon goes to the moon and beyond. And if not, then you have a stop here. Now, you have earnings tonight, so anything can happen. But like I said, you can at least not let, if the charts play out as they indicate, as they look to me as they will, as they should, that back test of the 40, this was, again, this was just the first kickback rally, this one right here, in what is probably a new bear market in Amazon and in the stock market. So you don't want to be caught in this. And if it is, Elliott wave, you can look up Elliott wave theory. If we're going to go into a 5-wave primary, trend, this was wave A, or wave 1, I should say. Wave 2 is the first kickback rally. Wave 3 is the most powerful wave. So if you think you saw a big move down here, If this plays out in some fashion of a 5-wave cycle for Elliott wave, you're looking at something like that, and you don't want to be caught in a wave 3. It's not going to let you out. If that is the case, if we do have a reversal here, and we're about to hit down a primary wave 3, you're not going to have an opportunity to get out. This would have been your opportunity. So I'm not trying to use fear mongering here, and hey, maybe I'm wrong, but that's what it would look like if we do play out in that fashion. All right, a couple more, and we'll wrap this up. Going pretty long. Apple, formerly the world's largest company, no longer. Here's just a chart I've shared for years. The drops, the corrections after divergences, and the divergent lows too, which are your times to go long. What that's lacking. I want to say that's lacking on just about every stock and index I see on the weekly time frame. We don't have bullish divergence, which makes me think that unlike these, we had bullish divergence back here. They were in an ongoing bull market. Those were great times to go long at this divergent low, at this divergent low. I don't have that right now. So my best guess on Apple is maybe a little more upside, maybe come and kiss that 40-week. I love the 40-week as a defining bull and bear markets for Apple. Does a really good job when you get in the uptrends. Tells you stay long until you break that 40-week like you did right here. And then you're in a bear market. You broke the 40-week here. You back tested it, and you didn't regain it to right here. So it's a very simple trend indicator to use with Apple. We are well below that 40-week. Apple is in a bear market. Make no mistake about it. Don't be confused about the recent rally. Maybe it's over. Maybe this is the best buying opportunity in years. I don't believe so. I believe this is just the first leg down in a bear market. There was a primary trend line, again, off the early 2016 lows broken. Hard for me to say. Apple is probably, of all of them, probably looks better than most of the bigger stocks out there. Maybe more upside, maybe not, but ultimately I see it coming down here. And again, it just has so much overhead resistance. And the charts, corrections are usually not one and done. This was a one move down, one leg without any kickback rallies. This is only kickback rally we've had so far. Corrections usually don't end that way. They usually work their way down and have, counter trend rallies along the way. So that's that. Next one up, Alphabet. Okay. I don't know. Chart speaks for itself. I don't think you can define a trend line any better than this with all these reactions. Again, by defining it, it's a number of reactions, clean reactions off a trend line. There's that 40-week moving average, which is also contained. You can see it containing all the pullbacks along the way during the uptrend. And then what broke? Not by mere coincidence. Both the trend line and the 40-week broke at the same time. Alphabet came in, back tested both of them right here, fell again, back testing the 40-week now, still well below the trend line. Trend indicator is clearly in bearish territory. The only other time, again, we're looking at a decade of price history here. The only other time that trend indicator was bearish was back here. That was on the part of a drop. There was the high right there, but I'll just go off this point here. That was a 17% drop. So we're not going to call that a whipsaw signal by any means back there. And so that's it. Oh, and the big divergence as well. All right, Facebook. There's Facebook. Good news today. This is as of yesterday. They had closed under there. They're rallying up 11% today. And I've said for weeks now, this was the best looking chart of all the FANG stocks. FAAMG is what I refer to the top holdings. You had the 50-day, that yellow trend line and the downtrend line coming in here. Big, strong, bullish divergent low. So that one popped up today, but we'll see where it ends up. Again, that's just one of many things. And now let's just look at a few others, non-tech. JP Morgan Chase, probably, I believe, the biggest bank out there. Very clear defined trend line off the 2016 lows, broken. Divergent high here. We had a second divergent high, or called a double, maybe even a triple top there. And this one's been moving down since. It lost support here. The key levels that I'm looking at on this chart are this 103.70 level right there. Pretty much you had the stock in what appears to me to be a topping pattern. Similar to a basing pattern down at the lows, but in reverse. You had a stock come up here, traded sideways for about a year, made that very significant support since we had so many tests, finally broke down, and we're back testing. Again, TA 101. I don't care how bullish or bearish you are. If you look at this through an objective lens, I may be wrong. JP Morgan may come back up in this range, but it doesn't get any better than that for a shorting op when you have a clean breakdown of a well-defined, very well-defined support level, along with a key moving average. It's also done a great job at finding the trends, and you're back testing both from below. This says short here with a stop above. Trend indicator is bearish, and that's it. So if you get stopped out, then no big deal. But the where this pattern might project, well, I can see. Let me tell you. You take a double top pattern. The measured target is you take the distance of the pattern, you add that to where the pattern breaks down. We almost hit that. We'll say that's almost been fulfilled, but not quite. And again, there's a lot pointing in the longer term charts that I think JP Morgan could be coming all the way down here before all said and done to about the 60, 69 level. And I'm talking, later this year, possibly even next year. J&J, another, one of the largest companies. Again, I'm going down in market cap, in descending order of market cap. So right now, this is the 1, 2, 3, 4, about the 7th largest holding in the S&P 500, again, by market cap. And this one hasn't cracked yet. So like I said, there are still a few things where the market is kind of clinging, or a couple of stocks are clinging to some key support levels, key trend lines, and I will give it that. So while a lot of things have broken down, some things and some key stocks have not. To me, this looks like flagging action. We'll see if it plays out that way. What I mean by that is you have an impulsive move down. This is called your flagpole. Followed by a period of sideways to slightly upward consolidation. That's a bear flag. And so if you have J&J break down, and you'd want to see it impulsively, two things would happen. We'd have, number one, a breakdown below the bear flag pattern. That's certainly a sell signal. And even more importantly, a breakdown of a very well-defined multi-year uptrend line as well. And that, again, that's just the rough measurement for that pattern. Again, you take the flagpole, add it to where the flag broke down, and that gives your measured target, and that would come in somewhere about 107 for J&J. All right, we'll wrap it up here, or maybe look at ExxonMobil, because that gives us an insight to the energy sector. ExxonMobil is the 800-pound gorilla. It's by far the largest, energy stock. And ExxonMobil and Chevron Texaco CVX, or Chevron now, they make up alone, I think it's half of XLE. So you don't have to know where XLE is going. You just have to know where ExxonMobil and Chevron are going. And if you're going to trade XLE, the energy sector ETF. But what stands out to me here is just a well-defined support level. Resistance, I'm sorry. We had reactions there, reaction there, reaction there. We've come up, hit it a couple times. We failed. Trend indicators are bearish. So it needs to get above there. If you're an energy bull, you want to see ExxonMobil clearly get back above this level. And then if so, you have some resistance up there to overcome. And then if it gets really, if things get really good for the energy stocks, and I doubt this would, if the market's going to take another leg down soon, we're not going to see this happen on XOM. So this is probably contingent on the market, again, because it is a top component of the S&P 500. But there's a very important primary downtrend line to watch if we do get some upside traction in XOM and the energy stocks. All right, guys, we'll wrap up here. I know this video is much longer than usual. Remember, if you're a YouTuber or a member of the site, you can increase the playback speed on these videos. Hit the settings icon on YouTube and increase it to 1.5, whatever you can take in. I'll listen to videos at 1.75 speed usually to just get them over with quicker. So that's a tip for you. All right, guys, hope you enjoyed it. And as always, thumbs up are much appreciated on the videos. If you could do that, that would be great.